Today, folks, we got to talk about SCHD. For all you dividend lovers out there, this is by far one of the largest positions in my entire portfolio, and I've been getting relatively wrecked on this quarter over quarter as this thing continues to decline. I'm now down about 8.17% on my 650 shares, as currently I have a DRIP set up, a dividend reinvestment plan to continue to take advantage of these lower suppressed prices as we talk about where I think SCHD is going, as we review about the top 6 or 7 holdings. And if that is a conversation you'd appreciate, as always, hit that like button, because I am using this ETF to fast track my financial independence to perhaps one day retire early, getting that juicy passive income. One day I will draw against this retirement account without touching the initial shares, hopefully long before the age of 60 or 65. I want my golden years to probably be closer to my 40s than my 60s. But taking a look at SCHD here, the stock over 5 years still has pretty resilient performance and has been pretty much flatlining toward the downside. From the peak to trough, it's down about 17.68%. From the recent lows, it's actually up 1% still, but year to date, it's just been continual bleeding. And luckily, that dividend reinvestment plan is capturing some of these lower prices for me, as I can only contribute to that retirement account once a year, and I tend to max it out. But nonetheless, taking a look at the dividend growth, this has become lackluster at best since the peak of 2022, where we received a 70-cent dividend for a quarter. As of recent, the most we've been able to peak is about 65 cents as of 2023. I think this dividend growth is probably going to lackluster maybe for the next year or two, as higher interest rates continue to take effect on many of these infrastructure focused companies that are actually held within the SCHD ETF. And we're going to break down some of these top holdings just to see where they sit. A lot of medical companies, CocaCola, we've seen quite a few of these earnings already, but I do want to highlight that against the broader market, where we're seeing a lot of tech company earnings that are actually a lot more resilient than I think people were expecting, those stocks have rallied aggressively, and we're starting to see them sell off even against a good earnings backdrop, which truly shows the sign that they have been overbought. The price to earnings multiples have been getting out of control, and a lot of that has been priced in. So I do appreciate the healthy pullback across the board. Makes it very awesome to cost average into the S&P 500. If you're a tech lover, a lot of good deals could be presenting themselves here soon. But when it comes to SCHD, I highly doubt that most of these companies have actually picked up their price to earnings multiple, considering across the entire ETF, it trades for around a 14.36 times, which is incredibly low. Actually, that is considered about a market average. The median PE ratio over history has been around 15. The S&P 500 has been trading around 20 plus. So this is actually a very healthy point to start at, in my humble opinion. There's just a lot about this ETF that screams, it's a good place to be buying it when the yield, over the last 30 days is sitting at 3.93%. It'd be nice if this peaks over 4%, but again, we're talking about an ETF that is only charging about a 0.6 or 0.06% expense ratio. So you are keeping the vast majority of these returns to yourself. So on that note, let's actually take a look at some of these top holdings. We'll kick it off with Amgen here, which actually hasn't posted earnings yet, and it's been one of the better performers this year with a starting 3.22% dividend yield. So we'll see how this performs, as it's been a pretty mixed earnings period across many of the medical stocks we're about to look at. Second in line, we should talk about the communication giants like Verizon here. Verizon actually had a pretty big pump after its earnings. It did jump about 8 to 10%, which I think is coming as a bit of a sign of relief after the stock has tanked 16% this year, and it's tanked a lot farther from those highs. I mean, the thing is down 45%, and I'm not expecting a crazy recovery in these until they start cutting interest rates, but we should start seeing a leveling off as the company is proving fairly resilient. Taking a look at the earnings here, I did do a video on this. We can see the total operating revenue declined slightly, but they are seeing a pickup in some of their segments, which is really nice to see. And again, the dividends are very affordable in this one, actually. If we take a look at the dividend payments here, the quarterly dividend did increase on a year-over-year basis, so they're still pumping that up a little bit. And 0.65 is, or sorry, it's 0.665 is actually very affordable, because if we take a look at the earnings, if we go back up here, we can see the total net income, attributed to Verizon was about $1.13. So they can't afford this dividend. Lots of room to play with here, and it's likely the earnings are going to remain kind of in this trend for a while. We're probably not going to see huge growth, but probably not a lot of downside. Subscription-based services in the telecom world is a very healthy place to get, reliable income. You just got to be patient, because infrastructure costs are, damning the entire industry, as we've seen in the Canadian telecom giants as well. Taking a look at AbbVie here, this one got hit on earnings. It dropped about 5% and is now trading down 15% on a year-to-date basis. And this is the third largest holding, but keep in mind they're mostly equal weighted, all making up around 4% 4%, or about up to 4.5%. So taking a look at AbbVie here, AbbVie's operating earnings have actually declined pretty dramatically, which came as quite a shock to me. You can see the net revenue actually went from 14.8 billion to about 13.9 billion, with total operating earnings going from 4.6 to 2.28, which again is quite a shock to me, to say the least. All things considered, AbbVie's actually increasing the dividend on the backdrop of these not so great earnings, which could just be a cyclical aspect of their business. But they announced their 2024 dividend increase of 4.7%, beginning with a dividend payable of February 2024. So it's kind of intriguing to see that we are going to get that, as they kind of diluted EPS guidance. They have a floor for it between $10.70 to $11, which excludes any impacts related to the acquired IP R&D and milestone expenses. So it'd be neat to see, these pharmaceutical companies see big fluctuations in the revenue on the regular. But yeah, AbbVie, very intriguing here, to say the least. Now, taking a look at Merck & Company, which is the third largest position we're going to be, the fourth largest position we're going to be analyzing here real quick. This company's also been kind of trending to the downside. It's down 7.25%, but this one's on the backdrop of much better earnings. We can actually see their sales went from 14.9 billion to 15.9 billion, and their net income sitting at 4.7 versus 3.2. Though I don't think we had a dividend increase on this one. That is a 46% increase on net income, and the stock is barely sputtered. It looks like it actually went down on its earnings, which is very intriguing. So we're seeing kind of this mixed bag of earnings across these entire stock holdings in SCHD. CocaCola, Warren Buffett favorite here, posted some pretty incredible earnings. Probably one of the more resilient earnings we've seen in its history. It's also down 12%. Starting yield right now is 3.32%. So this is probably presenting a bit of a buying opportunity here, as we can see their net operating revenue basically went from 11 billion to 11.9 billion. Very healthy across the board. If we take a look at basically income before the taxes, we're going from 3.44 billion to about 3.53 billion. So pretty much an increase across the board. Can't really complain. I honestly think in comparison to Pepsi, these were much better earnings, but Pepsi did post, still reasonable earnings, and Pepsi is one of the largest holdings in the SCHD ETF as well. But continuing on here, if we take a look at Broadcom, this one has been by far one of the best performers this year, up 51.54%. Absolutely just crushing it. Also posting earnings that saw some pretty moderate growth. Net revenue increased on a year-over-year basis by about 5 percentage points here, which isn't too bad. Cash flow from operations did increase nicely here from 4.42 billion to about 4.7 billion. Free cash flow did increase nicely as well. Nothing too crazy for the growth here. I'm not, for semiconductor stock, I'm really impressed at how much this thing has increased just in the semiconductor space. Probably a lot of hype, based on AI, cloud computing driving a lot of this, but that also is, what's just happening. I don't know if this is too much of a pump here. It's trading for price to earnings multiple of 25, probably getting a bit priced in here, but still can't really complain, I guess. It's just the mixed bag of stocks in SCHD. Very intriguing. So let's talk about Chevron real quick. Chevron and Coca-Cola are two major holdings in Warren Buffett's portfolio, the billionaire mogul, and this one got absolutely clobbered on its earnings. It's down 13.95%. Price to earnings multiple getting fairly reasonable here with the dividend yield of 4.15%. And I'm kind of shocked to see the big drop in this, but I'm not a big oil guy. We got some quotes basically from some analysts here saying throughput at Chevron's refineries was in line with expectations, but margins were weaker, delivering the weakest segment result in the past 6 quarters. So I don't know if this is a short-term hiccup. Chevron's a huge company and is doing a lot of acquisitions right now. They've got big, natural gas proponents to their business they recently acquired, and a few other things within their pipeline. But still, take a look at this because it was quite abysmal. We're talking about taking a look at basically the earnings per share going from, again, pretty impressively from this is a quarter over quarter. We want the year over year here. You can see it went from 14.95 to about 10.14, which is a massive drop, 29 billion to 19 billion. Basically getting rid of a good 30%, almost 30% of their total revenue here. So this is some stuff we're going to want to pay attention to. It could just be cyclical aspects of some macroeconomic events for them. Maybe could turn around here sometime soon, set up a buying opportunity. It'd be neat to see if Buffett ends up buying more on this massive dip after, purchasing the Occidental Petroleum. But nonetheless, those are the top holdings to see how they've been performing through earnings. We got Pfizer in here as well, Cisco. These top holdings, I think, are still incredibly resilient companies, and I think there's going to be probably some continued pain across the broader markets that don't represent the Magnificent Seven. The big tech companies have much more resilient balance sheets when it comes to the aspects of their debt, so they're not hindered the same way by the higher interest rate environment, but that also presents a better buying opportunity because if you're like me, you probably believe at some point in the future they're going to cut those interest rates, and that's when companies that are pretty much a lot of companies within these dividend ETFs are going to start performing exceptionally well as they start adding that back to their bottom line. So I'm hoping this persists for the next 3 to 6 months. I do want to do a lot of buying across the dividend space, and I'm hoping we get a good couple quarters of this opportunity set up, as these are dividend yields we haven't seen by far in decades in a lot of these stocks and these ETFs. But I'll pass that question off to you. I'd love to know what you think in that comment section below.